and services deficit increased at $2.9 billion, or 7.5% from January 2014. Exports decreased at 3.3%, or 1.7%. Imports decreased at 0.4%, or 0.4 billion. Are at 2%. Goods and services 3-month moving average here decreased 3.1 billion to 193.7 billion. That's a 3-month rolling average. Imports of goods and services decreased 3.1 billion to 236 billion in January. That was in January also. Year over year, the average of goods and services deficit increased 4.9 billion for a 3-month ending in January of 2014. The average export of goods and services increased 0.2 billion from January of 2014, and the average import of goods and services increased 5.1 billion from January of 14. Exports of goods decreased 5.5 billion to 128.7 billion in January. Exports of goods on a census basis decreased 5.9 billion. Industrial supplies and materials decreased 2.2 billion. Fuel and oil decreased at 0.8 billion. Other petroleum products decreased at 0.3 billion. Net balance of payment adjustment increased 0.4 billion. Export of services decreased 0.1 billion to 60.7 billion in January. Decrease was more than accounted for by the decrease in transportation at 0.2 billion, which included freight and port services and passenger fares. In financial services, 0.1 billion. In maintenance and repair services, 0.1 billion. Increase in travel for all purposes, including education, 0.2 billion. And in other business services, 0.1 billion were partially offset. Imports of goods decreased 8.9 billion to 190.3 billion. Excuse me. In January, imports of goods on a census basis decreased at 8.7 billion. Crude oil decreased 4.5 billion. Other petroleum products decreased 0.7 billion, and the net payment adjustment there was 0.2 billion. So, real goods in, we now have $2,009. The real goods deficit decrease was 0.4 billion to 53.6 billion in January. Real export of goods decreased 2.4 billion to 120.7 billion. And real goods imports, real imports of goods decreased at 2.8 billion to 174.3 billion. Revisions. Exports and goods of services were revised for January through December of 2014 to incorporate a more comprehensive and updated quarterly and monthly data. In addition to these revisions, seasonal adjustments for all months in 2014 were revised there. Thus, the revisions to January exports and goods and services revised down 110 billion. Exports and services were revised upward 0.2 billion. Revisions to December imports goods were revised downward at 1.1 billion. Imports of services were revised upward at 0.2 billion. And goods and services by select countries here. The fourth quarter figures show surplus in billions of dollars with South and Central America 15.2, Brazil 6.6, and I believe these are in billion. In the UK, with the UK 3.7 deficits recorded in billions of dollars, with China 83.4, with the European Union 22.8, with Germany 19 billion, Mexico 15 billion, Japan 12.9 billion, Italy 7.3 billion, India 6.7 billion, South Korea 4.1 billion, France 3.4 billion, Saudi Arabia 2.1 billion, with OPEC 1.8 billion, and with Canada 1 billion. Deficits with China increased 2.7 billion to 283 billion in Q4. Exports increased 3.5 billion to 43.8 billion. Imports increased 6.2 billion to 127.2 billion. The deficit with South Korea increased by 1.9 billion to 5.1 billion in Q4. Exports increased to 1/10 billion to 16.5 billion. Imports increased 2 billion to 21.6 billion. And these are all seasonally adjusted here. So that ends the import-export part of it. Let's get a little analysis here by the Reuters people. Somewhere we have it here. And we just wanted to make a quick note here. This is from Reuters. U.S. investors may be bracing for a further sign next week that the Fed could increase interest rates sooner than later, with retail sales expected to rebound for two straight months. A pickup in retail sales could show consumers are benefiting from sharply lower oil prices, but analysts say spending in February was likely occurred by the usually harsh weather in parts of the state. We talked about that already. The S&P ended the week more than 2 points off March second closing record, while the NASDAQ was 70 points under the mythical 2,000. According to Kim Forster, she's a senior equity analyst at Fort Pitt Capital in Pittsburgh. The Fed is back at top of the circle in terms of investor focus. This is where macroeconomics is king. I think they are feeling some pressure to show they are data-driven. Well, they are data-driven. This is the Fed we speak of. The economy has been getting better. What I'm thinking they are trying to do is to overstate the party to make sure the economy is really better. No doubt about that. In the job data on Friday, unemployment dropped to a 6-year low. A Reuters poll conducted following the report. Many of Wall Street's biggest banks are convinced the Fed will raise interest rates in June. While a stronger U.S. economy is better for U.S. Market, in the long run, investors have worried if the Fed raises rates too soon, it could dampen the growth. No doubt about it. Besides retail sales next week, the preliminary March reading of consumer sentiment, that's from the University of Michigan Sentiment, unexpectedly fell in February from an 11-year high. And of course, now Apple has entered the S&P. It rose there. It had displaced AT&T. Also on Monday, the European Central Bank is due to begin its €1 trillion stimulus, quantitative easing there. And that could increase volatility. That's according to Jeff Carborn. He's a managing partner at Cornerstone Financial Partners in Huntsville, North Carolina. You look around the world and you've got a deflationary environment in many countries. He said a rise in interest rates is knocking at the Fed's door, but there still doesn't seem to be enough strength out there to make it happen. And this is one of the problems that the Fed face. Part of the problem is Wall Street and much of the financial world in the U.S. has been fixated on inflation, and this was old time economics. We live in a totally different era now, that inflation is not what it once was. And even at that time, 3% on inflation was very good for the U.S. economy. Now, when you had 18% inflation, I can remember some people that had CDs, they were rolling them over at 18 and 19% there. So it was very good for savers. Low interest rates. I was listening at a Chicago station today, and one of the banks there was offering 0.1 or something like that on a year certificate of deposit. Totally waste of time. You could bear the money in the backyard or wherever and collect almost as much interest. So in other words, low interest rates are not encouraging for savers, and savers have to put their money elsewhere. But if they look to such things as precious metals, etc., they are not doing much better. Let's get to the BBC here. Here we go. And it's their headline is, of course, the 295,000 jobs added in the U.S. Kind of a summarization here. And the euro versus the dollar. Let's see if I'm not sure what we're going to get here on this. I didn't preview this, but basically, if you look at some of the basic currencies, is basically what they are doing here. And I don't see. Oh, here's the euro. It was down 5 cents there, so not something significant we need even to look at. Let's jump back here to Apple replacing AT&T on the Dow. We looked at that, a very interesting situation there. It will join the Dow Jones. It replaces AT&T, which joined the barometer in 1916. Apple was excluded from the Dow because of its high stock price would distort the price weight index. A change in the structure of Visa shares, which is the same sector, has made room for the iPhone maker. Visa shares will split, 4-for-1, which reduced the weight on information technologies there. Apple is a clear choice for the Dow, that's according to Don Blitzer, chair of the Index Committee. Apple's own 7-for-1 split there that Apple did, and so now Apple is there. AT&T is out. AT&T was out in the mid 2000s briefly, and as they say, made a return to the Dow. Nothing unusual or miraculous in that particular situation. That many of these go out, many come in. Let me grab some more information here from the BBC. And see if we get anything new. U.S. bank stress test. This is one of the reasons we use several sources here, and sources. 31 U.S. banks have passed the first hurdle. This is the Federal Reserve stress test, so the latest rounds of annual stress tests to see how they cope with the next economic crisis. Central bank says banks have enough capital to keep lending during a severe global recession. But some Wall Street giants were among the worst performers. Let me name those. Goldman Sachs, Morgan Stanley, J.P. Morgan Chase were amongst the 5 banks with the lowest rating for capital ratio of at least 5%. The ratio compares capital the bank's ability to withstand losses with loans it has issued, which are weighted for relative risks. In the next round of tests, the Fed will determine which banks can maintain those capital levels and still return money to shareholders. On Wednesday, the central bank will approve or reject requests for an increase to shareholder payouts as dividends. The tests were designed